Hi, good morning, everybody. It is Thursday, December the 8th. This is going to be a really short video because there's not really too much to go over. Yesterday, Monday morning quarterbacking, yeah, it was a fucking perfect day. But again, after everybody got once bitten, twice shy, you're going to call out a safe spread. You're going to call out a safe spread. You're going to stay on the edges. And yesterday, I still expected that we would do everything in our power to try and get that 39.46. Just didn't have the guts because of what was going on over there with crude oil. And yeah, had a nice flat day. You can see here your healthcare doing quite well. A little bit middle here, discretionaries, but yeah, your technology, which is your legs, absolutely abolished. You didn't have anything to do with the Nasdaq yesterday, unlike what we had on Monday, where Monday was pretty non-involved. But I'm going to take you straight to the charts to go over where we have already gone over. And as you remember, sent out there on Monday and was already preempting this as we were last week when we hit that 4100. We're looking for downside on a big wider picture. I've got the 123, and we failed to get that minimum level up there at that 4118. So it's not completely out of the picture, but I am still considering this because on the futures and on SPY, we did just barely reach up to that level. So, because we didn't do it in the SPX, it's a little bit of an asterisk like Barry Bonds with the home runs. But yeah, we've had our downside, and you can see the downside is a pretty distinct check mark. And yesterday, just everything established came down to the 38.2 retracement from that November low, broke down below it, still continued to hold above this 39.11 over here from back in November, that high at the first day, which is again where we basically have our throw in the towel level right there at that 39.11. It's held above this low over here from mid-November at 39.08. So it's just holding on by a fraction. But what we're looking at here from either point of view, whether you're bearish or you're bullish, because PPI is tomorrow, you've got CPI and FOMC coming out next week, but we have a very distinct situation of what's going on here completely, as what I'll go into here and zoom in a little bit closer is we're looking at the downside move here, the 1-2, and we've got our 3 all the way through the 200 extension, which tends to be an ABC, where the C is 2 times A, still holding that level there and holding right here at this 39.30 level. We'd still like to see that 39.6, 39.60 to start seeing. We are getting at minimum the bear bounce somewhere up to that 39.80, 39.90 level. If we do break up into the 4,000s, we can start thinking that this was a completed wave 4, and we are going to be heading back up into that 4,100 level. But I'll show you here from a wide point of view, because again, this is very odd. I don't listen to media about what's going on out there, but I do listen to TD Ameritrade just to have some background noise when I'm trying to go to sleep at night. And even they are out there and they are absolutely confused as to why you are getting a sell down on the bonds, on the treasuries, and you are still getting a little bit of a sell down over here on the stock market. So I've got the 1, 2, 3 that completed up here. Back over here in June of last year, you had your wave 4 and wave 5. This is a completed bull run on treasuries. That's the way that I've got this thing charted. And looking here, just coming in from where you were, come here on a 90-day. You can see here how you've peaked, and now you've got your 1, 2, and you're progressing to a 3. You got a 23.6 retracement already hit over here. You've already taken out the lows of this little wave 4 from wave 3. This is hunting down here in the 28s, meaning to say that the 10-year is going to be below 3%. And the way that you get the 10-year below 3% is because you're looking at 10 years. You're not looking at tomorrow. You're not looking at 2 minutes from now. Powell comes out and pauses rates or only raises rates a half point and says, we're going to let us see what those 0.75% rate hikes, those 0.75 hikes did. because it takes time for those interest rates to factor in. And if you start seeing the PPI and the CPI have the reflection that those interest rates are starting to work, you're leaning stronger and stronger towards a Powell pivot or a Powell pause as you come into this FOMC meeting next week. So, again, everything looks to be set that we should have completed our traditional start of December dip. It did coincide with the full moon, which you can talk to Suresh about. We have tracked this for years. And now you're looking at a very weak VIX on a lack of buying activity, little bit of a dip that is waiting for some headline to come out so that they can go and rally on it. So that's what it looks like. Either way, no matter what, we should be seeing a bounce up around that 39.80, 39.90 level as we head into the FOMC meeting next week. So, anybody with any concerns that are in those 410 calls, that's the way this is laid out. If you want to 1 minute manage it with 3 weeks left on it, that's all I can tell you for now. But yep, you still have this gap up here to be filled. And actually, quite frankly, go back on it. This is a chart I use where I'm working off of on a regular basis. You still have this big gap to be filled back here from the CPI. So, again, you've got two different views here, and you are dead smack in the middle. And we've pretty much been dead smack in the middle since Tuesday when we failed below that 39.55. So we're in stuck zone, and we're waiting for a headline to come out. And whenever that does come out, then we'll basically have clarity, and everybody can either throw their hands in the air or point the finger. Catch you in the chat.